It's 9 a.m. in Shanghai, Shenzhen, and here in Hong Kong. You're watching the China Show. I'm David Ingles with Yvonne. Man, we are counting down to the open markets in Greater China today. Let's get your top stories. Stocks across the Asia-Pacific rising on a subdued U.S. inflation report, easing concerns here about imminent Fed rate hikes. The S&P 500 is within striking distance of a fresh record, but U.S.-listed Chinese shares slip.
We'll be watching Tencent in Hong Kong after ADRs fell, with markets skeptical that its big boost in AI spending can't help it catch up with rivals.
Also ahead, the PBOC stepping up reverse repo usage, planning mid-month operations for the very first time. And China mourns Rongji, the former premier who overhauled the economy, has died at age 97.
All right, we cleared out two certain things here overnight, right, when it comes to not just the Tencent earnings, which we'll talk about, but that U.S. inflation print was pretty bang in line with estimates, pretty modest at best. So I think that really kind of cleared the pathway for stocks, for gold to do quite well here today. But Tencent, I think, we've been waiting for this AI Capex spend from the company.
They gave it.
And investors not quite liking it.
No, it was quite a big jump from the previous year. They also went negative in free cash flow, which we'll get into in a moment. But yes, I think the market reaction to Tencent was, I guess, in some ways unsurprising, given how markets have been reacting to big Capex spends of late. So we'll obviously track how that drags into the benchmark today. We're looking at a big drop, of course, in the ADRs overnight. In fact, let's have a look at how that's faring, right? So everything excluding Chinese oriented equities and securities are actually doing well. Although I should mention some of the earnings in the after-hour session in the U.S. are somewhat pulling down the index on the NASDAQ. But all that is also to say the S&P did gain. And then you did get also a very strong rally in the semis when you look at the Philly Semiconductor Index, which really outperformed in the overnight session. Also, I guess that goes into the next board that's coming up on your screens. There's a really bullish tailwind coming through on hardware plays because of what took place overnight. So you have Taiwan, you have Korea, which is now, I believe, back in a technical bull market. We're up 20% on that. Singapore's coming online. And, of course, Japan also the feeling the tailwinds there of the Capex story, 1.5% to the upside. Okay, we talked about Tencent, how we did overnight. We're also looking at some changes to MSCI China with the likes of Pony AI, one of the many stocks that were shifted out. You have a lot more shifted back in as well. We'll get to that iteration in a moment here. 2.4%, as we were pointing out here, going against the grain of risk assets overnight. Tencent, 5.5% overnight. And A50 futures are coming up on your screen. Should show still slightly to the upside. Last we checked, there we go, 0.4%. A50, of course, more indicative of onshore trading. 1.7 on the 10-year yield. We have auction bond sales here in Hong Kong. I should mention that too. 6.75 on the exchange rate today.
All right, things looking pretty positive right now. Let's break down, of course, the Tencent second quarter results and bring in our China correspondent Min Min Lo with what stood out to you beyond just that Capex spend.
Yeah, the Capex spend, I think, has been the main thing that investors are watching out for, right? And in fact, some analysts are reducing their price target because of the higher investments. They spend so much that we are seeing the first negative cash flow since 2021. They're spending more than they're taking in from operational income. And that's even with very strong revenue, double-digit growth, 11%, which was better than estimates. And it's coming from their bread and butter business, like the gaming business, ad revenue. That's up by 14, I think, and 22% respectively, and it's thanks to AI that allowed clients to better target their users. But again, when it comes to AI investments, the company didn't give us a multi-year guideline, unlike Alibaba, which has pledged $50 billion in 3 years. They did say they're going to double investments in AI products this year, and any additional investment is going to be tied to returns on their existing investments.
Yeah, and if they can't use up the capacity they sent, there's also always the worst case option of renting some of the assets out.
That's right. That was a bit of a controversial statement because according to our Bloomberg intelligence analyst, Robert Lee, he's saying that really doesn't show you confidence that they are, sure about their AI strategy. But you cut it another way, you could see it as a form of reassurance to investors that this Capex spending is coming with very limited downside, right? Because yes, if they overinvested and they have excess capacity, they can just rent it out. The company did say that they are going going to prioritize that AI infrastructure for themselves, for their long-term product development. So they might sacrifice a bit of that short-term gain because they can immediately make a quick buck by renting out compute. But first of all, their products are still lagging behind, right? Especially when you talk about the foundational model. Hunyuan, it's now rebranded as High 3, just launched recently, but it's still a very, very small model if you compare it to the frontier models like Kimi K3 or Alibaba's Quen. So the company says it's going to invest in a state-of-the-art model, High 4, which will be released later this year. Some of its other applications have been doing quite well, like WorkBuddy. That's a desktop AI agent. It just launched in March, but already has zoomed to the top of the most used products out there, outperforming its competitors. So that creates a positive feedback loop because it is powered by their Hunyuan model. They're also testing their AI agent for WeChat as well. That's in the prototype phase. So yeah, still in that process of trying to make WeChat an AI-first app. But again, longer term, the profitability and the payoff in that AI investment is going to be key to watch.
Yeah, I think WorkBuddy, they said, is achieving rapid user growth. Did they give any clear timeline on the return on investment on AI?
They did not give a very clear timeline on that. They have kept it a little bit vague, and they just mentioned that AI investments is going to, future AI investments is going to be tied to current returns. Yeah, so again, I think it's still pretty impressive. This is one of the few companies that can spend so much and still have, that double-digit growth in revenue to give that cash flow buffer, right? So, I mean, it's the sort of clout and cash reserves that the pure play names like Minimax and Zhipu will not be able to compete with. So that is its competitive mode right now.
All right. Min, thank you. Our China correspondent, Min Lo there. And it's not just Tencent, right? We got a busy earnings day here when it comes to Hong Kong and China. You take a look at when it comes to Seagate Asset Holdings, Seagate Hutch. You have some of the semiconductors that are reporting as well. So Hua Hong, Semi, Hygon, IT Tech, JD Health, and JD Logistics, JD.com. Lenovo, that's a big one here as well. MTR, and of course, SMIC. So, Dave, you've been kind of crunching the numbers. You've been looking at really what we need to be looking out for in this earnings season in particular. Yeah, so I think today we're looking at north of 350 billion in terms of combined market cap. And, of course, the benchmark we're using there is the broader benchmark here in Hong Kong. Of course, there are others that are also reporting onshore. But I guess just to give you an indication, of course, of basically share portfolio, right? So I think we talked about your really, really big ones. And a lot of these names actually reporting today have been featured substantially into the AI story in China, right? Lenovo has had following that earnings, that first quarter for Lenovo, right? It was a massive world-beating rally that followed there. So this one's going to be interesting later today. We're also looking at SMIC, of course, as far as fabs are concerned. Right. Now, in as far as the market reaction that is being priced in the options market. And as you can see, what this shows you is is it coming out as orange? It is, right? Okay. The orange bar indicates the implied mood post-earnings, that it's plus minus that 10%. So Lenovo is poised to see a substantial move. And the average compared to what you're seeing in yellow here, which is the average over past results, I think that's over the last year or so. So almost double what we've seen, including the last one we saw back in post-first quarter. JD.com also reporting, as we were pointing out, MTR is also seeing perhaps the opposite side of that. 4%, 2.5% is the implied. Now, speaking of these two companies, Lenovo and MTR, stay tuned for our conversation with both their executives. Tomorrow, the CFO of Lenovo will be joining us, and also the CEO of the MTR Corporation on the back of those earnings that are set to report later on today. Right, we are going into the open just over 20 minutes away. 50 futures are called higher. Tencent is very much in focus, should be indicated lower. We'll get to that in a moment. This is the China Show. Okay, before we get into the weeds of this, should we call it tameflation story? No. Just to mention, Tencent is also something that we're tracking in about 9 minutes' time. We should be getting the pre-markets in that, and we are indicated lower on that. We're about $20, Hong Kong dollars a pop there, to the downside. Now, speaking of, so low inflation is not really helping some of the growth and momentum stocks, growth related to the internet platforms here in Hong Kong, but we did get a soft
inflation number, at least not a terribly negative surprise as far as that was concerned, right? So what rates markets did was they pared back a little bit in terms of the hike expectations for September. We went from nearly a coin toss odds to about a third, 30 to 40% probability of a interest rate hike next month. So not completely off the table, but somewhat off the table for now.
Yeah, let's talk more and bring in Tracy Chen from Brandywine. She's been, of course, tracking all this, portfolio manager there. Tracy, yeah, it's interesting, right? We've trimmed off some of the rate hike bets, but we haven't really completely written off the possibility of a rate hike for September or even later on this year. How do you interpret this U.S. inflation print? Do you think we can rest a bit easy now, or the debate still has not been resolved?
Yeah, I think today's inflation number is just as people expected. It is like both the headline and core inflation. So to me, it's almost like a non-event, right? Initially, the market reacted sharply. Treasury rallied and equity rallied, but at the market close, most of the move already faded. So that shows you the market real concern is not inflation. Most of the Treasury sell-off recently is driven by real yield or term premium. Inflation break-even has been very stable. So I would characterize that the Fed should feel some kind of relief, but that's not the real story behind the Treasury sell-off. And the Fed is still behind the curve on tackling inflation and to reach their inflation target. So I think this will not make them more likely to hike. And I think it's really hard for the Fed to hike in September because it's so close to midterm. But at the same time, you hope they should have hiked in July, right? Because the inflation is still elevated. Yeah.
Yeah, the benefit certainly of hindsight. I mean, when you look at absolute yields, say on the 10-year, I mean, they've certainly crept up over the last few months. I mean, did markets just tighten policy for the Fed? And I guess related to that question is, we had that auction as well in the Treasury markets a few hours ago. Did that give you any better insight into how the market actually feels about the inflation story?
Yeah, I think if you look at the positioning, the CTA positioning, it's people are underweight duration right now. So it doesn't take a lot for people to cover their underweight. So I think in the near term, Treasury can have a bit of a rally, but I don't think that will last long. And so hence, I think the auction should go well because of the simple fact that people are so underweight, and I think they will price less a probability of hike. So you can see 2-year can rally more than the 30-year. You will see a curve steepening in the near term, either bear steepening or bull steepening. But there should be some kind of a steepening to gradually price out of the September hike.
Okay. How are you looking at Jackson Hole and what Governor Warsh is going to say? Because, I mean, it was a pretty rocky start for his first FOMC meeting in terms of the messaging around inflation. What does he need to do in order to fine-tune that message now, you think?
Yeah, I think he will be try to be as vague as possible because he focused on less communication and let the Fed follow the market rather than the other way around. So I think we'll be closely watch the 2-year because the 2-year is the markets doing the Fed's job. Bond vigilante is doing the Fed's job. So I don't think there will be a lot of takeaway out of the Jackson Hole, but I could be wrong. And I can't imagine he will say anything new there.
Tracy, yeah, that is wishful thinking already if he does, in fact, give us a little bit more. But Tracy, just before we talk about, obviously, the rising rate environment, also in the Asia-Pacific, JGBs and China, I just want to get your thoughts on, we've been talking a lot about AI. There's been a widening of credit spreads with all this fundraising that's going on from Mag 7 and some of their peers in the industry. I wonder, do you think the market has now figured out what credit scores to attach to those securities? What do you think is going on there with the widening of spreads?
I think there's just too much supply, and there's a skepticism on the AI trade. But if you look at the global AI arms race between China and US, it's quite daunting to see which one will slow down. So I think the hyperscaler in the US, they are forced to just keep building out the infrastructure because the demand for compute is still very huge. And if you look at CoreWeave's the earnings report, it shows that they have so many backlogs. So at the same time, I do think the credit market will have to absorb a lot of supply. That is why I think the credit spread will continue to widen from here, especially the IG part. For investors, we have to pick bonds, right? Not all data center credit are created equal. You can see them trade differently. It's the investors' concern about which one will survive, which one will be going default going forward. So I think JP Morgan estimated there will be $5 trillion of Capex spending from hyperscalers. So the entire AI build out from now to 2030, and most of the spending will fall on IG credit and private credit, and high yield and securitized are a tiny part of that $5 trillion. So that's a lot of that's a lot of demand for capital, and that is exactly why I think the cost of capital will go up. You can view this as a fiscal stimulus from AI company. So we're going from a government fiscal stimulus to private sector fiscal stimulus, and it's the same to us. Credit spread will widen from here. Just a matter of supply.
Which I guess is a good problem, or something good that, if you're a financial official, you'd rather they spend it than you do. What does it mean then for DM rates moving forward then?
Yeah, I think I have been witnessing this regime change pre-COVID versus post-COVID. So pre-COVID, we have so many savings, and then you don't have enough investment. So the cost of capital is so low. We have ZERP or actually negative real yield. But post-COVID, we have massive government spending, and there's a wealth transfer from government sector to private sector. Household has been locking very low mortgage rate. And corporate, they have been refinance their debt to get very low cost of capital. So right now we are very constructive on both household and corporate, and less, or I can say negative on the sovereign, especially DM sovereign, because the fiscal picture is just very ugly. So I would say we are more constructive on credit rather than the DM sovereigns. I think yield will stay high for longer, if not going higher for longer. And inflation will also be elevated because there are just too much fiscal spending. Yeah.
What does that mean for the dollar? I mean, we've seen that correlation between rates and the dollar kind of break down. Does that stay divorced for a while? What does it mean for dollar?
Yeah, I think the breakdown of the correlation between dollar and rates is mostly driven by fiscal concern, because foreign investors, they will look at the U.S. fiscal, they are concerned. So I think dollar is the most difficult question. It has a lot of drivers, the U.S. exceptionalism, the AI Capex, and then you have this geopolitical conflict, and then you have this relative central bank policy, because right now we see a discrepancy among all the central banks. Some central banks they are pausing, like Australia, but BOJ, they are lagging behind the curve, and US is a little bit lagging behind the curve, and then BOE probably will buy some more time because their economy is so weak. So at the same time, I would say it's really hard to see the dollar. I think in the near term, dollar can be a little weaker against the Asian currency, because Asian currency they are so cheap, right? Korean won, Japanese yen, and CNY, so they have room to rally from here, especially if China wants to internationalize their currency. But U.S. dollar can be stronger than euro, and then weaker against the LatAm currency. So it's a mixed picture.
Yeah.
I guess as a final question, is the cleanest trade on rates than China, with a stronger currency, stable, stronger currency, and you really don't have an inflation problem?
Yeah. CGB has been the true safe haven for the past 4 or 5 years. Ever since COVID, as the economy slowed down, property market is going through this recovery. So I think that's why domestic demand has been relatively weak. That's why CGB has been doing so well. But China is, the so-called K-shaped economy. They are focusing on technology self-sufficiency and AI build-out. So I think it's not just one single lens. You can look at China. You have to look at both the new economy versus the old economy. But the new economy hasn't been able to offset the old economy yet at this juncture.
Well, patience is a virtue. I think someone's told us that some time back. Tracy, thank you so much for that. Tracy Chen, their portfolio manager at Brandywine Global. We're going into the session today, 7 minutes away. We're looking at Tencent down about 3%. More than double volumes in the auction right now in the pre-markets. We're up down 3.3%. Plenty more ahead. It's a massive earnings day across mainland China today. This is Bloomberg.
All right, your agenda for Greater China today, we're watching that overnight reverse repo, right? So there was an announcement that they were going to start conducting it mid-month. And so obviously we're hearing a little bit more about them using this sort of tool. So certainly we'll get more indications on what implications that might have on the bond market and the like. There is this bond revival that we're watching very closely as well. Tencent, of course, front and center. We have plenty of earnings on tap. As we had a big list up there, like Lenovo, SMI, CMTR are just a few. We're still waiting for some credit data out of China, and of course that bond sale in Hong Kong today.
Yeah, we have that, of course, very much on tap today. Really amidst this, let's call it this window of stability across rates markets as we go into the thick of the Thursday session. We are called lower, as you can see, across the benchmarks. A lot of that might have to do with the fact that you have one of the biggest, heaviest weighted stocks down about 3%. In the form of Tencent. So that's something, of course, we're tracking today. Not to just also mention there are other earnings to tell you about. So Galaxy, for example, plus, of course, the approach to all these upcoming ones coming through. Anthropic, by the way, this line crossing through here, said to be in talks to buy AI startup Descartes. $6 billion is the price that is being talked about there. The opening bell, 3 minutes away. This is the China Show.
Welcome back. You're watching the China Show. We're counting down the open of markets. I apologize. I have a very croaky voice today. Battling with a cold here right now, but I'm going to power through for the next 2 hours or so.
She's fine.
I'm fine. That's why I'm at work here today. Just think of Phoebe Buffet.
Well, I was about to say,
right?
It's a good mix between Phoebe Buffet, Michael Bolton, and a little bit of Harrison Ford.
Oh, really?
Yeah.
Wow. That's a good combination.
A lot of gravitas
Way to
there.
sell it.
Yeah. I'm not sure if I did.
Yeah, no, so there's two things that we were a little bit more clear about, right?
Sure.
Whether it is about U.S. inflation, it seems like there's not as much urgency for the Fed to hike in September. That certainly is helping the likes of Korea, for example, now back into some sort of bull market after the chips are getting a bit more momentum. And then Tencent, right? Finally, we get some AI Capex spend. But it's interesting the market reaction that we've seen. Yeah,
they've been waiting for more details and more tangible plans and a number really from Tencent.
And they made it all about AI during the earnings call.
170%, I think, was the jump, if I'm not mistaken, on Capex spend, and then markets went the opposite way. So open on mainland here. Just to note, too, right, the China index is actually moving up, and I think that really goes to show what Yvonne just talked about, the revival of the hardware trade just about across the board. The China has been very tied to what's been happening on the Philly Semiconductor Index, what's happening in Korea. That's one to watch. Now, just to mention that, too, so you have bottom of your screens, CXMT's up 3%. Flip the page. We're going to see what Hong Kong is doing, and shortly after that, you'll see what Tencent is doing. The reason that is relevant today is, given the price action today, CXMT up, Tencent down, we now just could have, at this point in time, China's biggest company changing hands from Tencent to CXMT, just in terms of market cap, right? So Tencent coming up on your screens. There's been a lot of changes as far as price targets on the street are concerned. We've unpacked the earnings for you. There's been a lot of attention on the Capex spend. Tencent should be down about 3.6%. Volumes are also picking up quite substantially in the opening minutes, 4 right now. On Tencent. Right. We'll table this very, very quickly. Just to also mention before we forget it, there have been some changes to MSCI China. There's been a whole list of deletions and a whole list of additions to the index as well, just to see what the market reaction is. So we talked about the AI story, and we do have the infusion of a lot more AI representation in the benchmarks themselves, with the likes of Zhipu in. Stock is reacting 6.5% to the upside, and some of the additions there. We had the deletions as well, please, very quickly, so our viewers can get an idea of what's coming out. You have China Vanke, you have some of the solar companies, and also Hesai and Pony AI are also being removed from the benchmark there. But yes, this is something that we'll obviously track as people try and, of course, reconfigure their portfolios alongside the changes to the benchmarks.
Yeah, in terms of what the street is saying about Tencent, right, the sell side, for the most part, was, in fact, looking at that AI Capex spend with a little bit more of a negative lens, right? You have the likes of Goldman, Morgan Stanley actually lowering their price targets there for the stock because of these higher AI investments, right? So $670 now for Goldman is their price target, $550 for Morgan Stanley. Citi, though, actually raising their price target for the stock here and really revising that operating profit growth estimates as well. That's going to be pretty interesting to get Alicia Yap to talk us through all this right now. She joins us, of course, Citigroup Global Markets Asia MD and head of Pan Asia Internet Research. Most of the market took that AI Capex spend negatively. How do you look at it?
Well, it is understandable, given it is a really big amount. It's a big jump, right, this quarter. I think my initial reaction is that, oh, they're actually able to spend. Because previously, I think they've been talking about they wanted to spend. It's just that they couldn't spend it, right, on the right time, right? But now I think finally they're able to procure, I think, the delivery of, either the memory chips or some of the GPU from the domestic side. This is probably prompting the Capex number, and also the prepayment, right, to secure some of the procurements is also, results in the outflow for the cash flow this quarter. Yeah.
It's likely not a one-off Capex spend. You were on the earnings call. What is your indication of how much more they are likely to spend over the next few quarters then?
So we raised our Capex assumption post this quarter. Previously, we were way too conservative given we haven't seen anything that coming in, right, the past few quarters. So we are now, for 2026, even for the next 2 quarters, we are raising it to 65 billion, coming out from the 53 billion this quarter. Okay, so this year, full year, we are at 200 billion. And then next 2 years, we are also above 200 billion. So that means the next 3 years, we are actually total about 600 billion.
Wow, okay.
Is it concerning that they're basically turning free cash flow negative at a time when that pathway to monetization on these AI investments is still maybe not as clear, or do you see it a bit differently?
This is only 1 quarter, but if you look at the operating profit that they're able to generate, right, so it's actually over 300 billion, right, full year, on the full year basis. So sometimes it's just a 1 quarter impact because they have to prepay, right? So for example, if you wanted to sign certain contract and your customer asks you to prepay, you have to, prepay to secure, right? So I actually think it's just a timing of some of the outflow. But on the full year basis, their core business is still generating decent operating cash flow.
So no need to raise money?
They have some existing debt. We obviously don't know what they're thinking about it, but if they want, they can tap into the debt market and all that. And then they also have the investment portfolio, right, that they can also sell down if they really need it. Yeah.
Okay. And does it look like they do need it, or is this? It just seems a mismatch in cash flows and liquidity.
It's just a timing, yeah.
Okay.
I think it's a timing. And then I think management did mention on the call last night is that some of these costs is fixed cost that is more upfront loaded. So they we shouldn't be expecting them the same amount, the same magnitude forever, right? So that seems to be implying on the management message yesterday.
In terms of the AI product lineup for Tencent, obviously there's been a lot of talk about WorkBuddy being very popular. What do you make of the whole lineup, whether it's the LLMs, the coding assistants, and the like? I mean, do you see them stacking up pretty competitively with the likes of Baba or ByteDance now?
If you look at, they did highlight 3 key areas. One is their Hunyuan model, right? So now it's a Hunyuan 3. They are working on the Hunyuan 4. It's not the SOTA yet. I don't think Hunyuan 4 will be the SOTA. They don't expect Hunyuan 4 will be the SOTA, but they will continue to work on it. One day they're going to reach SOTA, okay? And then the next thing is WorkBuddy, which is the productivity agent, which is already generating some revenue, even though it is small, because it's not for everyone, okay? It's for enterprise, for prosumer, individual, professional, but that actually is already quite effective, okay? And they will continue to work on and fine-tune and potentially getting more user onboarding the WorkBuddy. And then the third one is the consumer AI, which is the Xiaowei, the AI agents inside WeChat, which in the future, you and me could actually easily maybe just using a voice and say tap into, and then they can function some tasks for us, okay? So these, I think they did also mention into the future, the Xiaowei is not going to use a lot of the inferencing because first, I think obviously the in-device inferencing could be coming along over time. But then in the meantime, the VLM, which is the model that's specifically designed to fit the Xiaowei AI agent, is a very, very small model. And then all the inferencing costs actually will be very small compared to the other LLM that we are looking at.
And we're coming off lows very quickly now on shares of Tencent. Is it clear to you, and it could be a longer-term story, but is it clear to you that there will be fresh and new revenue streams coming through because of all the investments or is it, are people going to be spending more time? When does their scale start to show up basically in the AI story?
WorkBuddy is already a new revenue stream that they don't have before. This is actually able to charge based on the token, right? And then I think the Xiaowei, the consumer AI, to be honest, I don't think there is a clear roadmap in terms of the actual new monetization. But over time, I think because like everybody's are using WeChat every day, so it's going to be enhance the existing monetization, which is either the gaming, the advertising, right, or the payment mechanism, like the transaction. So those will be the additions of the existing business. And then, they talk about into the future, if they have the access compute power, they are thinking about also the renting GPU business, right, which will through their cloud business. Okay, and then the model as a service, once their, let's say, Hunyuan 4 becomes a good enough, strong enough model, they could also strengthen their model as a service platform, which they could also generate revenue from there.
Okay, Tencent's just the beginning of this whole China tech earnings season. I mean, let's talk about the others. What are you watching out for the most for the rest of it? What do you think investors need to look out for the most this time?
Okay, next week, obviously, we have Baba, and then we have Baidu. Both of them will also show, the compute powers, like in terms of their cloud revenue growth. Baba, we in our preview, we raised our, cloud revenue estimate to 45%, so they are accelerating from 38% last quarter. So hopefully they're going to achieve that. And then for Baidu, last quarter, they already achieved like 80%, like 79% on the AI cloud infra revenue. So this quarter, we model 62. It's slightly decelerate, partly because, last quarter is so high. Yeah. And then after that, then we have, Meituan hasn't announced the reporting date, but Meituan is also another name that a lot of clients are actually paying attention to these days.
Why?
Partly because I think they bounced back really well from the low in end of June. Partly because of their earnings revisions is very clear. But I'm actually would be cautious. I think the expectations is building very high into the 3Q guidance as well.
Okay. Any indication that those price wars are something a thing of the past now?
Yeah.
I mean, are you starting to see more signs of that?
You mean the model pricing war?
In the e-commerce space.
Well, the
Oh, the e-commerce.
If we strip out AI, like how do these businesses actually look? Advertising and all these things, yeah.
Yeah, so the food delivery pricing wars is behind us. Okay, that's why you see the earnings recovery for BABA on the commerce side, for Meituan, and even for JD, which is tonight. And then on the commerce, unfortunately, the big pictures, the macros remain quite weak. So that will still wait on, the GMV and the CMR growth for BABA, for example.
Okay.
Yeah, and then the cloud pricing war, I think Tencent talked about yesterday. It seems like they are also able to raise prices. So it's not like, really that everyone is driving down the prices. It's indeed, they can, using the higher input costs to actually raise their cloud product prices.
Okay.
We've been talking to our guests this week about this. This seems to be a sea change in how people are looking at China big tech now. Before it was all, I'm just going to put everything on Jupu, Minimax, all these pure plays. And now there seems to be more of this rotation going back into the Mag 7, I guess, of China. How should I be looking at these pure plays now, just given the volatility we've seen? And the valuations still. Have we trimmed enough on valuations too?
Yeah, so I think it's good that people are able to rotate back and see the values for the China big tech, right? Because, the entire month of June, it was seems like, really, really.
They forgot about them.
Yeah, we forgot about them. And then finally, July, we see some rebound. And then people started to think, fundamental does, matter, right? At the end of the day, the valuation fundamental does matter. But I think the pure play will still be, a place in the portfolio allocation. It's just that I think people have to take into consideration it will be a very volatile if they actually have a higher proportions of their portfolio in those pure play. And plus, pure plays is just keep moving because we still need more time for them to show and demonstrate they can indeed deliver. Versus the big tech, we know that they've been around for a long time. They've been through many cycles. For example, with the Tencent, they were a bit late, but now they're catching up, right, and all that. So we do see, the returns should be coming in, especially for the long-term investor that have the patience.
Alicia, always a pleasure.
Yeah.
Thank you so much for taking the time to come in. Alicia up there, we covered everything, of course, including GD.com, which reports today, Managing Director, then Head of Pan-Asia Internet Research at Citigroup Global Markets Asia. Right, just to mention, since we were just talking about that, right, the chip story across mainland China, Chinex is rallying quite decently, 1.7, and of course some of the hardware plays like Huahong, SMIC, and these are the three, of course, that are reporting today. So keep an eye on this. And when you look at the other parts of the equity market across the Asia Pacific, on the Capex story, on the hardware story, on servers, and this is, of course, the iteration we're getting across markets in Taiwan at this point in time. We're up 1.3% on the benchmark there. Lots more ahead. This is Bloomberg.
Well, PBOC is set to conduct mid-month overnight reverse repurchase agreements for the first time. So really expanding the use of this new liquidity tool that was introduced back in June. Let's bring in our markets reporter, Anthony Stevens, on the significance of this and what the implications could be.
Right, so this is like a bit of a plumbing exercise, right? They want to move towards a more modern framework in guiding rates. So they had the benchmark rates before. Now they want a multiple kind of benchmark way to guide rates. This is on the backdrop of them looking to not be just a liquidity injection engine. So over the last 3 days, they've not injected any money into the system.
Yeah.
Judging that liquidity was ample. This is not a liquidity problem that China faces with deflation. It's a growth problem, right? So now you get a chance to treat the PBOC like the Fed. There's more kind of modern way of signaling banks in terms of using the repo. The second thing is they want to avoid this relentless disruption from one-off events. So one of the reasons this calendar is so interesting is tax season is coming up in China for corporates and people. Right? And there's a huge short-term kind of demand for cash that always stresses the bank system. And if you see how the short-term rates have been trading, you also see at month-end, quarter-end, year-end, these big spikes in rates, right? The PBOC wants to tell people, look, there's a fixed amount of money available. It's available regularly. Get your planning in order, use it properly, and as a result, we can guide rates more effectively in a narrow band, because these activities are done more regularly. Now, that's a very positive signal for China's fixed income market, because China's fixed income market has been growing and been growing pretty steadily. Rates are low, it's true, but Chinese fixed income has outperformed, and the size of that market warrants this kind of sophistication. So on the financial side of China, this is a very positive, indication. Yeah.
It improves the transmission of monetary policy and certainly makes it more modern because of the complexity of the economy right now. There was a notion when this first came out, and so they've made the announcement yesterday, but it's not like this is new, right? They've flagged this very early on.
They flagged it in June, right?
Yes,
so the PBOC comments around that big conference in June that this kind of modernization push is coming. They were open to feedback from the banks, how they can improve. So this is actually quite a nice consultation process with the banking system, right? They want the complexity, as you said, of the economy is growing so fast, and the monetary size of China is growing so fast. They cannot no longer use blunt tools, right? The sophistication gap with the US is starting to close. And this is very nice for me to observe that Wash is similarly focused on improving the plumbing of the Fed. So in terms of the complexity of the banking systems in both US and China, the monetary policies in both countries are trying to improve the efficiency of monetary policy transmission.
Fantastic. Anthony, great stuff. Anthony Stephens there, our Bloomberg's markets reporter on, just focus on the short ends at this point in time. Lots more ahead here on the China show. CSI 300 to the upside, 0.7%, 1%. MSCI China, of course, a lot of changes coming through as far as the internal tightening on the benchmark itself. We're lagging on the Hang Seng. Hang Seng Tech, though, seeing a little bit of a lift. A closer look underneath the hood coming up next. This is Bloomberg. Former Chinese Premier Rongji has died, aged 97. Zhu was a key architect of China's economic rise, who pushed through some really landmark state sector reforms and really helped pave the way for the economy's entry into the WTO in the early 2000s. For more perspective, let's bring in Stephen Engel, our Chief North Asia correspondent, here with us to talk us through this. I guess it's not an overstatement to say that he was really key in driving a lot of the major reforms here.
Yeah, which is interesting, too, given that he was one of the few premiers that only really served for one term, from about 1998 to 2003. But it was a pivotal 5 years, and his past before that really set him up for that pivotal role, which saw as well the rise of China into the World Trade Organization, which he was very critical in negotiating with all the parties, including Pascal Lamy, who was at the time the head of the WTO, praised him for his pragmatism and also, complete command of the issues at hand. Now, this is a guy that rose up the ranks as vice premier in charge of national economic policy. He was also the party chief in Shanghai, which helped build Shanghai and attract foreign businesses into Shanghai. He was on the standing committee of the all-powerful Politburo. He was also the central bank governor, the PBOC governor. Some of these were simultaneous as well. So he had a real outsized role in crafting the reform agenda, which some have criticized as well, because he dismantled unwieldy, large, bloated, indebted state-owned enterprises, laying off 40 to 50 million people, including where I lived up in the northeast of China in Shenyang in 1990 and 91 is when a lot of this pain hit the economy. But it was necessary, and some would say that he was the right person for the time, right? He also essentially set up the asset management companies that bought all the bad debt from the banks, recapitalized the banks ahead of their very high-profile listings with cleaner balance sheets that have now become some of the world's biggest banks. So he had an absolute critical role in reform and the battle on corruption, and also attracting foreign direct investment. He was a fluent English speaker. Some say he had a great sense of humor, which also helped, along with Jiang Zemin, who was the president at the time. The two of them were quite large characters.
You said he was pivotal at that time of what China needed, right?
Right.
Was a free market sort of stance, reforms that you mentioned about SOEs. How does that align or not align with what China looks today under Xi Jinping?
I think it's a very valid question, and one that's going to be debated for quite some time. How would Zhu Rongji fit, as his role back then, how would he fit in this administration, a third consecutive term under Xi Jinping, which some would say focuses more on ideology and a larger role of state-owned enterprises, a larger role of the state. Zhu Rongji really pioneered the push for private enterprise to rise, which has led to what we've seen over the last couple of decades, the rise of Alibaba, Tencent, and more recently BYD, even Huawei, which has state connections but is considered a private company. It's very interesting what kind of voice he would have. Under Xi Jinping, it's about loyalty. Zhu Rongji encouraged cadres all up and down the party to speak out. So it might run afoul of some of the more ideological policies of Xi Jinping, and as he has pivoted away from those market reforms, some would say.
Steve, thank you so much for the context and, of course...
Known to be a straight shooter.
Straight shooter.
Yeah.
Very much,
Always,
right?
Yeah.
Our chief North Asia correspondent, this is really why we dedicate really a chunk of our time to really discuss and unpack what is now a very complex and very large economy because of a lot of the reforms, of course, put in place decades back. Zhu Rongji, of course, passed away at the age of 97. Right, welcome back. We're going into the second hour of the China show. So Hang Seng Tech Index, a glance at the benchmark. Hang Seng is now flat, was opened slightly to the downside right now. I think Tencent was very much in focus. It's come off lows. It's coming up on your screens. We were down as much as over 3%. We're now down to about 2.5 points, 449. We've had some changes, of course, on the street in terms of price targets. A lot of the attention went to that massive Capex number, 170 plus from the year. First time it's negative free cash flow since 2021, which was a timing issue according to Citi. But, markets were like, OK, you've spent a lot of money. And if this continues, we'll need to see returns on that money.
Yes. I mean, investors were waiting for that catch-up story for Tencent for some time now. We finally got it, right? When they're talking about doubling AI Capex spend. But maybe it's coming at a time when the market is really questioning all this investment that's going on as well, and whether, when are you really going to see those returns when it comes to those investments. So it's interesting what Alicia said too, right? He said, look, at the end of the day, maybe some of this is just very front-loaded, right? That maybe this is a one-time thing, all these contracts that need to be signed and all that. But they still see maybe a little bit more of that visibility here when it comes to that sort of monetization, especially when they said, the earnings call was really dominated by all things AI and their product lineup there too. Yeah, so they Citi bumped up their projections on the business. They've also bumped up their expectations on the Capex spend. I think Alicia was admitted that she too was surprised with the number because there was very little indication that Tencent was ready to open up its wallet, and then they did. And I think the point of debate here, I think, which Rob Lee in a moment will get into, is how do we interpret the comment coming through from management that if they do find themselves in a situation where they overspend, then they could rent it out, right? Okay. Similar to what Meta said, right? Not too long ago, and that caused a lot of jitters in the markets.
Yeah. Well, I guess which goes to show why markets are still a bit uneasy. They're still trying to figure out what that means. In the meantime, though, so while we are making our minds up on that, what seems to be working, looking at the price action overnight, was this, right? You had the S&P close higher. You had tame inflation, not a problem for now. No strong indication that will propel the Fed to raise interest rates next month. I think pricing went from about coin toss odds to about 35-40% probability. So a little bit less, but still on the table. The SOX index actually outperformed massively overnight, and it really played out in as far as some of these benchmarks are concerned on your screens. Now, the Kospi index, if you're curious where that is, so we've actually carved it out separately because we are now back in a in a bull market on the Kospi index. We're up 20% from the lows. Yeah, like I don't know, like we've spent tons of time talking about the Kospi index. I'm actually struggling to find more superlatives for the market that has really watered this dry. But yes, here we are again. It's old winners seem to be the current winner still.
I think what we saw with the U.S. hyperscalers and the fact that they're still willing to spend a lot on AI, that really is bringing back a lot of enthusiasm back into Korea in some ways, right? Let's bring it back to Tencent, though, because certainly with the breakdown of earnings of BI.
Yeah, let's. Rob Lee's here to talk us through, of course, his take on the earnings. He's our senior analyst at Bloomberg Intelligence. So we're all yours. So what caught your eye?
Sure. Okay. To give a balanced view, I think Tencent, ByteDance, and Alibaba will ultimately, if I can get my words out, emerge as winners in this sector. However, we've got no real visibility on where the payback on their significant investment. So that is one thing the market is obviously concerned about. As you mentioned in your prelude, their free cash has gone negative to the tune of about $2 billion. In the context of a Goliath of a business with substantial cash generation, etc., this is of no fundamental consequence. So they are in the investment phase. They continued, or they are effectively doubling down and sharpening their focus on that. But there will be no bottom line return this year, and based on where we stand, it's unlikely to see it next year. I think also the issue and the reason that the ADRs in the States were down quite heavily last night, and also if you look at Process as a proxy in South Africa, I think the messaging, let's just say, was suboptimal. Because if I was presenting a new strategy, you want a very clear message. Now, I'm not saying Alibaba gets it right all the time, but they are, you will be in no doubt what Alibaba's gunning for. They're gunning for leadership of the sector. They're driving high rates of growth within their cloud business. It was a fairly mixed message from Tencent last night. And as you mentioned again in your prelude, the fact that they said, well, actually, on a worst-case scenario, we could deploy these assets externally to clients and make more money that way. I mean, it's a bit of a mixed message, and it doesn't indicate supreme confidence in your vision, really. It highlights the inherent risks, which I think are fair. So, again, to be fair to management, they're giving a balanced view, but the market doesn't like uncertainty, and I think that's why the ADR, etc., was down. So we're unlikely to get a payback, within the next 18 months or so. But Tencent remains better positioned than most of the subscale peers to do that in the long run.
And some have said, right, despite factoring in this significant investment into AI, they were still able to deliver some double-digit earnings growth, right, and especially in the core business. What were some of the positives to you? Yeah,
the core business is doing really well, and the numbers were in line. I think the expectations were a bit beaten down going into the print. And also, as you're aware, in the local context, Tencent's actually been, a fairly significant underperformer year to date. I think it's lost around 170 billion in market cap. Again, I don't think that has any long-term consequence. But the domestic video games was actually above expectations. That's performing very strongly. The margins there are very good. The international games business was a little bit weaker, but we did anticipate that. The fintech business, which includes the cloud business as well, is coming through. And I should say, lastly, the ads business was growing well over 20% top line, which, for a business of this scale and size is really something. So there is no concern whatsoever on the core business, but they're in the investment phase with no immediate prospect of a payback, and that's depressing margins. Well, okay, let me rephrase. It's not depressing margins, it's a headwind, it's a margin headwind. So if we didn't have the AI spend, we would have seen a decent margin improvement last night, and that didn't come through, but it is depressing free cash flow.
So what do you think they should do next? But maybe not the same question. What do you think they will do next?
Okay, well, as China's largest listed tech company, they have dual responsibilities, if you like. They've got responsibility to the state at a time where China's AI plus strategy is looking to drive the proliferation of the technology across the nation, for the benefit of all. So I think, they're in a fantastic position to do that. And clearly that is beginning to work with the hope that that will help rebalance the economy to high tech and ultimately drive economic productivity. So that's a real positive for the nation as a whole. But ultimately, Tencent and the other private sector companies are subsidizing that at the moment, which again, maybe from a moralistic, let's sort of leave that, but they have responsibility for. But then the shareholders are not going to benefit from a financial return at this point. I'd also say less so Tencent, but obviously companies like Moonshot, Jupu are clearly moving towards more complex, advanced models and narrowing the performance gap with the States, as we've seen. So China is making fantastic progress in terms of technological progress, but the profit really isn't there at the moment. And I don't think it will be there for the next 18 months or so, at least.
Well, they played a long game. Rob Lee has a fantastic piece separate to what we just discussed, of course, on the AI strategies between the pragmatic approach in China and, of course, the very frontier cutting edge that we're seeing in the U.S. And really, if you had to pick one, who wins out, right, as far as that's concerned. Rob Lee, fantastic, senior analyst there at Bloomberg Intelligence. Right, a look at global equity markets year to date into where we are right now as we move into mid-August. So we've done well, 14% on MSCI. All countries, so that includes world, including EM. And as you can see, chip plays have done and led the rally here with the SOX index up 75. Europe has done decently well. And as you can see, China's continued to lag year to date on where we are right now. So does the global bull run continue? Joining us here on set is Jeff Lee, Global Equity CIO at eFund Hong Kong. Good morning and very nice to see you.
Thank you. Great to be here.
Does that trend continue, you think?
I think so. The most important macro backdrop for the next few years, related to what our guests just talked about, the AI spending boom. We're talking about, in aggregate, $1 trillion incremental AI spending in the coming years. We're talking about a huge-scale corporate sector leveraging up their balance sheet. And that will give a huge boost to global economy. And we already see that impact on earnings this year. We see huge upgrade, revising up of global earnings of the sector across all sectors, specifically tech sector, but the economy is doing really well. I think this will continue. So that gives you a really nice backdrop for global macro. And then fiscal spending of global governments are not going to drag. Probably will add a bit more oil to the economic growth. Yeah. So we'll worry about too strong economic growth in the future, probably.
Okay, good problem to have.
Yeah, good problem to have. So you still think tech AI is going to be leading this market for the rest of the year, or?
That's right.
How do you position after this pullback we've seen?
I think I consider the pullback healthy, because it was between March and May. We have a huge rally. With the SOX, we see the performance. Other sectors were relatively quiet. They lagged. And what we saw was all the capital globally were chasing the investment, the stocks in this sector, in tech sector alone. And that's probably will not continue. That probably won't repeat, because now we have a divergence of opinion. About we talk about AI's ROI, we talk about sustainability of the company's balance sheet. So from here, people will have divergence opinion about tech sector. As a result, these capital who chase the tech rally will start to allocate into the rest of the market to find value relative, underperformed sector with still solid fundamental, but reasonable valuation. So I expect continued broadening of the market from here. Tech might still take the leadership role, but the market, the rest of them, it will not be as extreme as what we saw in the last few months.
People are trying to attach what degree of confidence they can on earnings, right? So I think when you look at it from the Capex perspective of the spenders, that's earnings to everybody else, with the exception of to the hyperscalers, for example, right? And so I guess my question for you is, when people worry about return of investment, is that simply a worry that is limited to the hyperscalers? In other words, can I trust in the earnings that is coming through across this part of the world in terms of that spend continuing to boost earnings of suppliers?
Absolutely. So okay, let's talk about what people really are worried about when they talk about ROI.
Sure.
The whole value chain start with, the model companies, the AI model companies spend a lot of money and, build capacity, and then that become hyperscalers, the cloud providers' revenue, and then the end users use those services.
Yes.
Use the model to do stuff. So you are talking about model, hyperscaler, and end users. From model perspective, we all know that they make very high growth margin. So they have decent ROI. That's why they will not stop investing. We see this. That's why we see them, continue to spend more money because they see positive ROI. From last couple of weeks, hyperscalers' earnings, we know they also make decent ROI. They can get their money back, their investment back at current rental rate in a few years' time. 2-3 years, they get the return back. So they have decent ROI. So all the burden are on the end user side. From the end user side,
to us.
You have yes,
okay.
and corporates.
Okay.
Earnings. Out of all the scenarios, codings have proven itself as high ROI activities. That's why coding become the largest revenue driver for AI companies. But what's not proven is applications outside of coding. We need to find a second scenario that as big as coding, as profitable, a high ROI as coding, to make people not worried. Now people are concerned about this, and what we see is corporates are cutting their spending on AI a little bit. In the past,
the users.
In the past, it's token maximizing. Now they do token rationalizing.
Sure.
So, we see corporates use more and more AI, but it's so much harder to prove AI can increase their revenue or cut cost. That ROI calculation is becoming much more murkier.
Okay, that's interesting.
So what does this next phase of the AI trade look like to you then, right? We've had this violent repricing of semiconductors, the picks and shovels trade. What are you thinking is the next phase looking like to you if you're saying the application side is actually slower than expected?
It's actually not too slow. No. The ROI, people are still, nobody want to miss the opportunity to use AI to increase their productivity. So I don't think they spend less. The corporate are spending less. But the market is questioning them spending this money. Do you have ROI for this spending? The next phase for AI, I think it will be the same as before. Okay. Those questions, the ROI question, we were asking, if you recall for the last few years, AI trade has been on for 3 years, 3-4 years. From day one, this is the question: what's the ROI? Every single year, the market will come back to an ROI question once or twice, and the sector have a decent pullback. But these questions can never get answered on day one. This is wait and see situation. Every year, we question the ROI, then some development in the sector happen that ease the concern a little bit. This year it was coding. Coding was a proven scenario, so no problem, ROI solved. Now coding become relatively, later phase. Then what's the next scenario? People worry about that again. So you have valuation pullback, but what you have is a huge multi-year, probably the largest sector trend we see in our career.
Yeah. Since the internet, yeah.
Yeah. So when you have a cheaper sector with unbroken trend, at least without those questions answered, even without those questions answered, these are still decent risk-reward situation now.
Okay.
So they will continue. So we'll wait and see the next scenario, but meanwhile, those companies, we saw the rally yesterday from the stocks. These companies still reporting great earnings, and these earnings continue with valuation kept at bay. That's a more sustainable scenario for the market.
And I think that's the conundrum people faced, right? Because if you strip out the AI layer and just look at the company itself and the ratios and everything else, that looks to be the most decent buy and easiest buy. But you also have all these frontiers and, these breakthroughs at the very edge, which could date some of those things. So I guess what I want to focus on is, apart from AI, and July was a very good reminder to not put your eggs in one basket, what are we ignoring and what is the counterweight then to AI?
What are we ignoring is...
what sectors do you think? Yes.
So when the tech sector was the only sector that was up massively, right, all the other sector lagged. But there are good stuff in there too. There are great companies in there, and they compound, 10, 15% a year. But all of a sudden, compared to tech, they're not attractive enough. So I think we're talking about a capital allocation phenomenon. Capital were chasing tech. Now they're gradually looking at other sectors. The laggard, for example, a few examples. For example, the global healthcare. It was an ignored sector for a while, but if you're positive, we talk about the next scenario for AI. It's probably most likely AI for science, AI for biotech, and if AI drive a productivity growth in healthcare, we're going to see a massive upcycle again in this sector. So when a sector lagged and about to have an upcycle, that's potentially a great opportunity. Also, quality as a factor.
Right.
We in the past we were talking about company with great moat, very long runway. Those companies get ignored for the last 2 years. We see constantly derating. Earnings become multiple derated from 40, 50 times to 20 times. Now they haven't changed that much. Some of them might get disrupted by AI, but we see a few of them are attractive buy now.
Jeff, thank you so much for that. That was Jeff Lee, their global equity CI at Yvonne Hong Kong. Right, so don't ignore quality as a factor. Healthcare, financials are also making a comeback just in terms of carving out mind space there. Lots more ahead. This is The China Show. Welcome back. So this underground market is reportedly emerging in China for insider tips on who could be next to fall in Chinese President Xi Jinping's anti-corruption crackdown. Let's bring in our senior Asia government correspondent, Rebecca Chen-Wilkins, joins us now to talk us through this. And what do we know about this emerging market that people are discussing right now, Rebecca?
Yeah, it's a fascinating development, Dave. It really, I think, underscores some of that anxiety that we're seeing around this pervasive anti-corruption purge that President Xi Jinping has stepped up in the last couple of years in particular. The latest findings come from a report by a magazine printed by Xinhua, and essentially looks at the emergence of these small social media groups that are purportedly purveyors of information, of secretive information about, for example, that cadres that might be about to be probed, or investigations that may perhaps be in the works. And for a very small fee, you can join these groups. For something more like sort of $60 or so, you can join a group that's even more purportedly even more secretive with higher levels of information. Now, the report itself points out that some of this is just entirely fabricated. It's really just about trying to raise money from people who are joining these groups. But there is some sort of legitimate areas of concern for authorities, particularly where we've seen, for example, leaks of personnel information. And so there is clearly an anxiety in the fact even that we've seen Xinhua or a Xinhua-related publication kind of put this forth, I think underscores some of that anxiety that authorities have to sort of try and clamp down on this. But of course, there is sort of use and demand for this sort of information. You think about the sort of upwards of 900,000 cadres that were probed last year, nearly 200 of them in central government, so more senior officials. Plus, of course, when officials are probed, there is also typically an investigation that's linked to a variety of companies that may be also linked to that official as well.
Okay, so of course, obviously there's some questions about how legitimate some of these things are, but what clues does it give us, right, when it comes to the qualities that the president will reward or really who he's going to select in his next cohort? I know there's a big one coming up next year.
Yeah, this is a really interesting question. And to your point there, Yvonne, just throwing this forward a bit, when we have the sort of plenum that comes up in October, we'll be looking really keenly to see precisely which officials will be removed or confirmation of that, as well as to try and divine what it is that Xi Jinping is trying to identify in the officials that he's keeping around. We know that from the very, very outset of Xi Jinping coming into power, he always sort of promised to tackle corruption of the so-called flies and tigers, both the low-level and the senior officials. So it certainly continues to be a really key part of his regime, particularly when we think perhaps of this president-defined fourth term that we may see from President Xi.
Rebecca, thank you so much. Rebecca Chung-Wilkins, Senior Asia Government and Economy Correspondent. We have lots more ahead. This is Bloomberg.
My initial reaction is that, oh, they're actually able to spend. Because previously, I think they've been talking about they wanted to spend. It's just that they couldn't spend it, right, on the right time, right? But now I think finally they're able to procure, I think the delivery of, either the memory chips or some of the GPU from the domestic side is probably prompting the Capex number, and also the prepayment, right, to secure some of the procurements is also, results in the outflow for the cash flow this quarter. Previously, we were way too conservative given we haven't seen anything that coming in, right, the past few quarters. So we are now, for 2026, even for the next 2 quarters, we are raising it to 65 billion, coming out from the 53 billion this quarter. Okay, so this year, full year, we are at 200 billion. And then next 2 years, we are also above 200 billion. So that means the next 3 years, we are actually total about 600 billion.
That was Alicia Yap, who joined us in the last hour, of course, around the Tencent story and certainly the focus of conversation, which is the Capex number. Quite a big one. 170+% was the increase there. In fact, she, as you perhaps saw there, they were not expecting, there was no indication that Tencent was ready to open its wallet. They did. There was a mismatch maybe of liquidity and cash flows. You had a negative free cash flow number coming through there for the first time in a quarterly basis going back to 2021. But yes, I mean, it's certainly the number that markets are focused on currently. There's a ton of volume coming through in Tencent, 3.5% to the downside. So we have, again, tested a low end of today's range. Now, I think what's interesting, too, is what BI and Rob Lee had to say about this, right? So Tencent obviously has sort of like a twofold, if you think about it, twofold in terms of priorities, in terms of the corporate and what this means, of course, for the broader AI rollout in China. And Rob Lee had his fantastic report out on the latter. So he's comparing the path that China and the U.S. and what they're taking, and what he says is this pragmatic AI strategy that will, in terms of China's case, low cost, not exactly at the very, very frontier, will still merit vast amounts of Capex and Capex spend in that separate path. But also when you look at the U.S., for example, and some of the more closed source path that they're taking as well there, and what that really means as far as this rivalry is concerned. Now, speaking of that, BofA Securities on the China side estimates by 2030, well, let's put it globally, then we'll go to the China side in a moment here, AI-related Capex could hit more than $1.7 trillion. Now, from that pool, China's own capital expenditure could hit $327 billion also by the end of 2030. That's accounting for about a fifth of global spend, and that is expected to boost copper prices, which are, by the way, already at a record at 14,000, and the metal is already up 43% since 2021, and BofA sees global copper foil shipments growing at 17% on a CAGR basis from last year into 2030. To discuss this report is Matty Zhao. She's here with us, the co-head of China Equity Research, the author of this report, and head of APAC Basic Materials, Oil and Gas Research. That's a very long introduction for you, just to underscore really the ton of coverage that you guys. Okay, so you guys have initiated coverage on a very specific part of the copper market. Tell us what that is and tell us why.
Yeah, sure. So we initiated coverage on the copper foil, which is key materials for the PCB and also the lithium battery as well. And of course, it's a downstream for copper. So copper foil is getting more and more tractions because of the growing AI Capex and also the growing demand of the AI PCBs as well. So copper foil, together with e-glass and resins, are the three key materials for the CCL, which go into PCB. As well. And normally copper foil accounts for 40% of the cost of the CCL. We expect the copper foil global market, like you said, to grow at 17% CAGR in the next 5 years. And at the same time, the high-end AI copper foil market to grow at 36% CAGR in the next 5 years.
How sensitive is the copper price or to really what you see when it comes to AI investments right now? Is it pretty correlated, you think, right now?
I think the direct use in AI for copper is probably account for about 2.5% of the total copper demand. So it's not that big. Of course, we are expecting copper use in AI directly to grow at about 18% CAGR in the next 5 years. So probably by end of 2030, copper direct use into AI will account for about 4% to 5% of total total global copper demand. But at the same time, you also have the indirect use, like, for example, the grid spending, the ESS, and all this is because of the AI, the use of power. So we are expecting China grid spending to grow at about 12% this year and at around 10% CAGR in the next few years as well to drive the copper demand. And then the indirect use, i.e. the power sides, will account for half of copper demand.
And is it an undersupplied market so far? Copper foil, specifically?
Yes. So copper is undersupplied and copper foil extremely undersupplied for the high-end ones. Because if you want to go into the high-end PCB copper foil, first of all, you need special machines. And then a lot of the machine has already been booked out until 2028. So these machines were produced by Japan.
Right.
And the key producers in China has already booked out all the machines until 2028. Secondly, you need 18 to 24 months certification to go into the downstream companies to get recognized as well. So in China, the high-end HVLP 3 and 4, i.e. the high-end PCB copper foil, only 2 companies have the recognition so far.
Okay.
Copper itself, though, we've seen record prices. A lot of it has to do with, I think, the demand picture you see, but the supply picture is quite tight as well. How should I look at also trade policy? Because I think there's a lot hanging over what the U.S. is going to do when it comes to tariffs.
Yes. Actually, the U.S. tariff on the copper side, I would say that previously market expect we have a clear picture by the end of June. But nothing happened. Now, probably market expect it will happen in January. So that's why a lot of traders are still arbitraging the copper prices between U.S. and ex-U.S., so still shipping into U.S. as well. And one of the near-term data we look at is China copper inventory. It has dropped from over 300,000 tons to now 70,000 tons. So drop around 70% from the peak in January. And now it's at nearly 4 years low of the inventories as well. And you have the peak season of the grid spending coming, the ESS peak season coming, and all these AI spends as well. And so that's why we are still very positive on copper.
Is it, I mean, it's easy for me to say it, easy for me to see that why don't they just restock? Just help us understand that dynamic. They were at 4-year lows. We've gone from 70,000, which seems like quite a low number on inventories.
Yeah, but the difficult thing is there is no supply. Right, year to date, supply has continued to miss. The major producing like Chile, Peru, the grade has continued to derate as well. A lot of the major copper mines from like Freeport, from Zhiji mining continue to delay on the resumption. So year to date, you can say the run rate of supply growth is less than 1% growth. So that's why there is very limited. And to be honest, if you want to restart a copper mine, general timing is 8 years for greenfield. So it's not that easy to resolve the problem.
How should I be looking at some of these copper stocks, right? I think you've been marking that the valuations have been quite cheap and really not really reflecting the fundamentals. Why do you think there is that disconnect?
It's also a head scratcher.
Yes. So if you look at the Chinese copper names, on average, it's trading at 10 times. Historical average is 14 times.
Global currently is trading at 20 times. So if you compare to historical average or compare to global, it's kind of now the biggest gap in terms of valuation. So that's why we've been pushing copper names aggressively, given the attractive valuation. I would say the reason, recently we already started to see copper name rebounds. But compared to global name, it's still underperform the coppers. The major concern is still more macro, uncertainty on US dollars, and then probably apart from the greed, other part, China demand is relatively weak, like for example, home appliance or for example, autos. People are still worried about the overall macro. I think that's the key reasons.
I see. I want to talk about the energy market if we can, because, you know, there's been a lot of conversation around that, you know, and we've had this before, right? That's the bottleneck on the AI story. There's not enough energy. But we know, of course, China has a lot of assets and capacity. Just what's the framework you guys are looking at as far as China's energy needs as it builds out its AI infrastructure?
Yeah. So I think power is one of the key advantage that China have in terms of AI. So we have a lot of the free power capacity. We have a lot of renewables. The grid is probably the most well established as well. Power tariff is 40 to 60% cheaper than US and Europe in terms of, so the cost of power is, and the availability of power is definitely one of the key advantage. But if you're wanting to look at more upstream, actually we also have some upstream issues, like for example, oil, we're about 70% reliant on import, gas around 40% reliant on import as well. Coal, because of a lot of fatal accidents. Recently, we have a lot of coal supply checks, and last month's coal production was down 10%. So there is still some issues affecting, but overall on this global competition, I would say China is well established on the power sides.
Okay, we're going into earnings season.
Yes.
So everything from, I mean, you talked about energy, so you have oil and you have gold as well. So what's top of mind for you as you go into the thick of your coverage next week?
Yeah, so I think some of the key stocks that people will look at is Zhiji Mining's reporting in the next few days. They already have pre-reports, so the profit alerts. So I think it's what the management is guiding in the new strategy, especially recently there have been some deals getting pulled off on the acquisition sides. And then also probably some of the aluminum like charcoal, Hongqiao, and then the PetroChina is reporting very soon as well. So these are the key names that we're watching for.
All right. Coffee to you and your team. There we go. As we get ready for sleepless on the sell side, as we call it. All right, Matty, Zhao, thank you so much. That's a joke, of course. Co-head of China Equity Research, head of APAC Basic Materials, Oil and Gas Research at BofA Global Research. Right. Just ahead here, it shows billions of dollars parked in Hong Kong trusts and insurance products are drawing fresh attention from Beijing. We'll examine whether China's offshore tax hunt has real teeth. This is Bloomberg. Welcome back. You're watching the China Show. So as China steps up efforts to collect taxes and overseas wealth, the attention is certainly turning very quickly to trusts and insurance products here in Hong Kong, wealth hubs, of course, globally. Let's bring in Shuli Ren, our Bloomberg opinion columnist, who talks about this uncertainty over how those assets are being assessed. It's creating fresh concerns for investors. She's with us right now to talk us through this. Shuli, yeah, your column today.
So even legal experts in mainland China, they have raised eyebrows at some of the taxations that China is imposing. For instance, China has talked about imposing taxation on insurance gains that mainland Chinese bought in Hong Kong, right? And they were saying, like, you need to give me 20% of your capital gains. And the legal experts in China say that, insurance income, there's no law saying that China has the right to tax insurance income, nor any law exempting it. So in practice, in mainland China, local authorities, they don't tax insurance income. So why should offshore insurance be treated any differently? Also, there's the issue with tax collection. believe it or not, it's the local authorities that are calculating capital gains and charging their residents with tax bills. And the different authorities, they have different treatments. For instance, the city of Shanghai, it is a little bit richer and they're a little bit more reasonable. They say, okay, I'm not going to tax you until you cash out on your insurance product. But Nanjing is poorer, and they say anything that's accrued or even if it's undistributed capital gains need to be charged. So imagine, we have a stock brokerage account. I have unrealized gains, and I still have to pay for it. So there's a lot of confusion around that.
Okay. So what is taxable? What is not? How is this all being calculated? What can Hong Kong do then to kind of blunt this impact, or what's coming from China now?
Well, one possibility is Hong Kong making itself a better destination for global asset managers. The Hong Kong government has been talking about passing a landmark tax reform bill, basically exempting all taxation on investment funds, also on the bonus their employees are getting. So that is one major thing. But other than that, there's not much Hong Kong can do, to be honest.
Do you see the industry being able to change some practices, or do we just have to wait for clarity here? Like, how do you see things evolving, big picture?
I think we just have to wait to see more clarity. Look at Hong Kong's insurance sector. It has done very well. Last year, new premium grew by 50%. And it's just a very good sector. But now there's so much ambiguity, right? Like what kind of products are being taxed? Like, for instance, how about life insurance? How about health insurance? How you calculate the capital gains? These questions, Chinese government has to address them somehow.
Shuli Ren, thank you so much. Our Bloomberg opinion columnist. You can check out her column, of course, on your Bloomberg terminal. And also, of course, you can get an insider's guide to the money and people shaking up the finance hub here in Hong Kong edition newsletter. Of course, it is very topical here in the city as a global wealth hub. And, of course, as we were just alluding to there, some of the big insurers here in the city have actually not seen their share price recover since we discussed this as we go into the thick of earnings season, the likes of Prudential, for example, and others in the industry. Whip out your phone, scan a QR code you see on your screens, and you can get that straight into your inboxes. I have a very special chart, by the way, that's coming out today. Check it out. Lots more ahead. This is Bloomberg. This fear of losing your job from the certainly adoption and uptake of AI has largely been focused on office staff, right? Programmers, teachers. But the tech is actually coming for the blue-collar workers too, right? They are now being recruited by AI firms to train the robots that may soon actually replace them. That's the topic of today's Big Take. Excuse me, and let's bring in our senior reporter for Asia, Sarita Wright, to talk us through this. Excuse me, Sarita. Fantastic piece today. So why is India actually emerging as a hub for this sort of trend that's been emerging across labor markets?
So, large language models, David, learned from the language of the internet, such as Wikipedia. But there isn't readily available videos or data to teach the models that can make the robots work. So robotic makers have to go find the recordings because the robots are, great on viral videos. They can dance, they can do choreographed routines, they can show off like amazing acrobatic maneuvers, but in real life, they are really abysmally inefficient. So India's, by a twist of economic progress, India is the place where a lot of people, millions and millions of them, really work with their hands. So now there's a race to come to India to capture these workers doing all kinds of things, working with their hands in the warehouses, in factories, in steel cutting units, in recycling units, in denim factories. So that is, that is the race here among global robotics builders to build something with this data that can make the robots work better.
Yeah, it's fascinating to see the pictures, right, where they basically strap on an iPhone or a phone and just start recording their hands. And I think some of the people that you even interviewed said they don't even know what they're really recording and what it's for in some ways. But tell us a bit more about the companies that are actually leading this race to really gather this sort of human motion data, and how are their approaches different?
So, this is really the newer facet of the US-China AI race, robotics, particularly embodied AI or AI that is, connected to physical devices and can interact with the real world. That's the next facet of the US-China AI race. So there are plenty of AI robotics builders in the US and in China, particularly, that are racing to get ahead in this field. For instance, in the US, everybody's heard of Tesla's Optimus, Agility Robotics, Figure AI. And in the US, in China, we've just had like a very big splashy debut on the stock markets of one of the most prominent robotics makers, Unitree. And there are, of course, others like Agibot and Ubitech that have already deployed many of these robots out in the real world in factories. But of course, the numbers are really, really tiny so far.
And I mean, what are the obvious and perhaps not so obvious implications on, the labor market in as far as the specific method of collecting data is concerned, Sarita?
Perhaps what is happening now in India, David, is probably one of the cheapest ways to collect data, get a bunch of smartphones, strap it onto the foreheads of people who are actually already working, never mind the discomfort, never mind consent and all of the other, privacy-related stuff. A lot of companies are doing this, and this is one of the most popular ways of collecting data, but there are others. There is, for instance, teleoperated data where robots are remotely controlled by humans to go out in the real world and collect data, which is much more accurate to the robotics world. There are plenty of different approaches, and the labor market implications, of course, are humongous. But, a lot of experts say that this is at least 5 to 10 years away. So it's not around the corner like a lot of things are happening in the labor markets in software coding, for instance, or consulting or lower level financial analytics jobs. This is a little bit away, but the labor implications for a country like India, where a lot of work is manual, is tremendous. Countries like India and China have to look at what this advent of humanoids in a big way will mean for their labor force. Particularly in a country like India, where there's a huge young working population. If these manufacturing and physical work goes away, then India has to figure out another way to employ these young people.
Yeah, that's a big issue. That's a big issue. Sarita, thank you so much. Fantastic piece there. The big take, of course, for today. Please check that out. Sarita right there. That's on the terminal right now. That's the function to go to that specific page is NI Big Take, of course, on your Bloomberg terminal. Right, just very quickly, Tencent, of course, is a stock we've been tracking, given, of course, the earnings and the Capex focus that we've seen there. And as you can see, shares have been bobbing around 2.5% to 3.5% losses here. We're at about the midpoint as we go into the latter part of the morning session. Some of the computing lease-related names on your screens very, very shortly. And on the back of that, of course, still a very heavy earnings stock here. In Hong Kong and mainland China, SMIC, Hua Hong, JD, and CK Hutch are coming out, of course, with earnings as well over the next few hours or so. Speaking of earnings, right, the other two coming up with earnings, MTR and Lenovo are also set to report later today. And tomorrow we'll be unpacking those earnings numbers with executives from the companies. Winston Cheng, CFO of Lenovo, and the CEO of MTR, Jenny Young, will be joining us here in shows tomorrow. Stay tuned for those conversations coming up. That's it from us here today. We will see you all tomorrow. Have a great rest of your Thursday. This is The China Show.